Just about a half hour, a little over that, to the opening bell on Wall Street. Let's bring in Paul Hickey, Bespoke Investment Group co-founder. You thought December might be weak, but a little bit weak after the run-up we've had. But the selling, the pervasiveness of the selling has surprised you?
Yeah, I mean, just how the persistence. I mean, we talked about it a lot been talking about it on CNBC, just how much we've seen just persistence day after day, negative breath. And I think part of it is just people, looking to ring the register, take some gains. We've had a very big year and reposition to go into the new year. And now to go into the new year, it's an interesting situation because there's, when we look at the year ahead, we just look at what could impact the market from a lot of different perspectives and label it a pro or a con. And there's pretty much an even split what we look at right now. The breadth in the market is good. Just overall, if you're betting against the market, you're betting against the prevailing trend. We're in a bull market 80% of the time. But breadth has been good. The AI trade, the AI stocks are doing well. The economy is doing well. There's concerns about the Fed becoming less dovish, but that's because the economy is doing well. And I don't think last week was much of a surprise when they came out. And I think part of the volatility we saw also coincided with the hiccups in getting the continuing resolution done. Wednesday, right around the press conference, was when we started to see the deal break down in the Republican Party. Yep. And then Friday morning, I think it was on this show, you had someone on saying there was a breakthrough and they were coming to a deal. And then Friday, we saw the market rally again. So I think the Fed shouldn't be ignored, but also there was just concerns that the path may not be as smooth going forward. But overall, I think the election and the makeup in D.C. for the next 4 years is a pro for the market rather than a con.
We're in the third year. You date the bull market, beginning of the third year. And after two big years like we had, 20% plus, that portends good things. And the bull lasts 5 years.
Yes.
But the third year is not great.
Yeah, so anyone with kids knows about the terrible twos. So when you're in when you get to your third year, the kids can be a little cranky. And bull markets, those periods, that third year of a bull market has tended to see below average returns. Through October, we saw some of the strongest returns, 2-year returns in history. And look, we were just sent this out earlier today. The S&P closed above is on pace to close above its 200-day moving average every day this year. It's happened 11 other times since World War II. The average return in the next year was about 4% versus the long-term average of 9%. And the last 2 times it happened was in 2021 and 2017. And the market was down the next year, both of those years. So it's just, there's a lot of good to think about. But I think at the same time, you want to be, restrained in your enthusiasm here because the market has rallied because of this good news.
Do you want chips, not blue chips, but chip stocks need to make a stand? That's worrisome to you?
Yeah,
you got 20 seconds.
Yeah, so chip stocks have been underperforming in the second half. They're a leading indicator for the broader market and the economy. And to see that weakness is another one of those concerns that balances out some of these pros.
Paul, thank you.
Thank you.